Switching gears here, fears at the Federal Reserve rising that markets just might not be getting the message. The Fed is serious about fighting inflation, and this is after recently released Fed minutes showed frustration that its rate rises are being taken as a sign that rapid slowing will follow. Market observers, meanwhile, worrying that a sharp slowing could tip the U.S. economy into a recession. Joining us now with more, we've got Tom Essaye, Sevens Report Research President. Tom, good to have you here with us this morning. The Fed has seemed acknowledging, at least in the past, that their policy pathway may cause a recession, but it's the extent of the recession that markets are trying to price in as far in advance as possible right now. But do you believe that there will be any swift pivot, given even the jobs data that we saw in private payrolls this morning?
Good morning, Brad. Thank you for having me on. The short answer is no. The two key variables that investors have to watch as we start the year are employment and inflation, and they need both of them to go down in order for the Fed to pivot, and it's just not happening. And we saw, the reason the market is down this morning is very, very clear. The jobs data is too good, and I realize that may sound weird to investors at home, but the bottom line is the Fed won't be confident that inflation is going to truly subside until the labor market gets less tight, and it's just not happening right now.
Well, Tom, what's the market reaction then if tomorrow we get a better than expected jobs report by a wide margin?
More of the same. We'll see continued selling because the market. So here's the interesting thing. In December, the Fed came out and said we're going to raise the Fed funds rate above 5% before we're done. The market does not believe them. If you look at Fed funds futures, they are pricing in a Fed funds rate at the end of this year well below 5%. So there's this game of chicken going on between the bond market and the Fed, and whoever is going to be right is what we have to watch as the year progresses.
Well, and we heard from the Fed again yesterday that they didn't appreciate that game of chicken, that they want markets, they want stock markets to be lower, they want yields to be higher. How do you think this is going to end up, Tom? Who's going to win in this game of chicken? I mean, usually, I don't know about usually, the Fed makes mistakes, certainly.
Yeah, absolutely. I think that, listen, we always have to heed the advice, don't fight the Fed, right? And we have seen over the past year that the Fed is serious about raising interest rates. But here's the thing. The Fed is just following the data. The Fed was late to react to the spike in inflation and now is chasing inflation higher by raising rates. And what the market believes is going to happen is that inflation is going to roll over and growth is going to roll over, and the Fed is going to have to chase the economy down by cutting rates as the economy slows. Now, that's not happening yet, but the market seems quite confident that it will happen, and this is part of the risk to investors as we begin the new year.
By your estimation, when would the economy slow to the extent that the Fed is looking for?
It depends, right? We're seeing some pretty quick deceleration in the growth metrics, especially in manufacturing. So one thing we have to keep in mind is you've got to separate the economy into two pieces, right? One is manufacturing, the other is service sector. Manufacturing is slowing. I mean, manufacturing may already be in a recession. The issue is service sector, right? The service part of the economy. That is staying very resilient. That is driven by employment. So if the Fed accomplishes its goal, we should see that really begin to slow, I would say, end of first quarter into the second quarter.
Tom, good to see you. Tom Essaye, Sevens Report Research President. Appreciate it.